Okay, hello everybody. Welcome to Korean Atlanta Mentorship. And in this video, we're going to talk about the first lien HELOC and velocity banking. Have you ever seen it promoted by YouTubers where they say, hey, you should just replace your low 2.5% mortgage with a higher interest rate HELOC? And I've done various videos about this, and I got this one comment from a month ago that I just wanted to show all of you. And again, I put the AI voice generator to read it. So we're going to read it out loud for you. So just give me one moment.
Okay, so I've watched a few of your videos and I can't disagree with your math. I am, however, unfortunately, someone that replaced their low 2.5% interest mortgage with a first lien HELOC at around 8% to help pay off a bunch of high interest debt. It's not the worst thing in the world because I am practicing velocity banking, but as you have stated multiple times in your videos, I will end up paying more interest this way. I wish I saw your videos about just getting a second lien HELOC and chunking at the mortgage, but here we are. My question is what to do now. It's not like I can just refinance into a 30-year mortgage at current rates. They're way too high for that.
Folks, there's a phrase in real estate investing. I don't know if you're familiar with it, but it says the best deal that you'll do is the one you walk away from. And so I don't know, I don't have any advice, right? Because again, if you know me from how I like to do demonstrations on this channel, I always tell you I'm not going to answer any of your personal questions. I don't give financial advice in this channel. This channel is kind of like Costco demonstrations. I just kind of do some demos and you decide if you want what I have to offer. Click the Google form link below. But other than that, I don't give personal advice because all I do is I see stuff on the internet and I go, that doesn't seem right. Replacing a 2.5% mortgage with the 8 or 9% line of credit. In fact, again, if you're unsure whether something is right for you, you may want to consult ChatGPT, right? Now, ChatGPT is not always right, and sometimes AI can't even do simple things like you ask it to draw a picture and it can't even spell correctly, right? You know what I'm saying? But it's a good starting point. Okay, it's a good starting point. So let's go ahead and ask the AI ChatGPT whether this is a good idea or not. All right, so let's go ahead and ask. Can you tell me if this is a good idea? I want to replace my 2.5% mortgage with an 8% HELOC and do velocity banking. Not baking. What's velocity banking? Is that baking? Is that a microwave? Velocity banking. All right. So 8% velocity banking. I see many YouTubers promote this, so I am interested in it. Okay, so let's see what the AI says. Ooh, risky. Okay, risky. Oh, what's this? Influenced by affiliate programs or sponsorships. Interesting. Okay, so let's go ahead and read it.
Replacing a low-interest mortgage, like 2.5%, with a high-interest HELOC, like 8%, can be risky and may not align with the core principles of velocity banking. Here's why. Key considerations. 1. Interest rates. A 2.5% mortgage is extremely low and provides significant savings on interest over time. Replacing it with an 8% HELOC increases your interest rate by more than 3 times, meaning you'll pay substantially more in interest on the same balance. 2. Cash flow. Velocity banking relies on cash flow efficiency, leveraging lump sum payments to reduce principal and save on interest. A higher interest rate, like 8% on a HELOC, may erode these cash flow benefits. If your current cash flow cannot sustain the higher HELOC interest payments, you could end up in a worse financial situation. 3. HELOC volatility. HELOC rates are typically variable, meaning they could increase further if interest rates rise. This adds uncertainty to your financial planning, which is particularly concerning when compared to the stability of a fixed-rate mortgage. 4. Promotion on YouTube. While some YouTubers promote velocity banking, it's critical to recognize their advice might not always apply universally or might be influenced by affiliate programs or sponsorships. It's wise to evaluate whether their strategies align with your specific financial circumstances. When velocity banking works well, if you have high interest debt, e.g., credit cards or personal loans, that you're consolidating into a lower interest HELOC, the strategy can save significant interest. When cash flow is strong and you're disciplined in using extra income to reduce debt, velocity banking can accelerate your payoff timeline. Alternatives to consider: 1. Maintain your current mortgage. Keep the 2.5% mortgage and focus on other financial goals like investing, building an emergency fund, or paying off higher interest debt. 2. Use a HELOC strategically. Instead of replacing your mortgage, use a HELOC for short-term needs or investments with high returns, ensuring the payoff is quick and the balance is minimized. 3. Hybrid approach. Keep your low-interest mortgage and experiment with velocity banking on a smaller scale, using the HELOC for managing discretionary debt. Would you like a tailored financial model to analyze this decision based on your current balances, cash flow, and goals? It could help clarify the numbers for your unique situation.
I appreciate the offer, but I'll just do this myself for this demonstration. And so we're going to just do a quick velocity. Well, I don't know how quick it'll be, but we'll do a velocity banking demo, right, with two situations. So, number one is we're going to consider the first lien HELOC, which ChatGPT says is a little bit risky. And then the second lien HELOC, which we use it as our main tool to manage our cash flow. And we can still use an 8% HELOC to attack a 2.5% mortgage, right? It's just we have to do it the right way. Now, why is it important to consider how we pay off our debt, right? We just cannot make blanket statements like, oh, replace all your debt with a line of credit. Well, because if I put this $400,000 2.5% mortgage and replace it with a line of credit, look how little cash flow I get. $400,000, I only get 1580 in my cash flow. I might as well, let's say do these two credit cards, pay them off quickly, and I'll get much more cash flow than focusing on the $400,000 mortgage. So if we replace our debts with a line of credit, there has to be a significant amount of cash flow, and we can attack the 2.5%, but in general, it has to be very last. Okay, so now this is what we're going to do. We're going to do velocity banking. So, a quick review of velocity banking. All it is a debt payoff strategy where you use your line of credit as your main operating account. So, for today's demonstration, we're going to do the first lien HELOC. So, what does the first lien HELOC mean? Well, basically, it means you're replacing this mortgage with a line of credit. So, think of it as like replacing your mortgage with a credit card, and then we're going to use it as a tool to pay off debt. Okay. Now, let's assume we're going to replace everything, including all these high interest rate credit cards, right? Um, uh, so we have high interest rate credit cards, the auto loan, student loans. So we see that all of these loans are at a lower interest rate than what line of credits normally are, which is about 8 to 10, right? I've had two home equity lines of credits, or I think three technically, two with the same company and then one with the current one. I have a first lien HELOC, believe it or not. So I'm not saying first lien HELOCs are bad, but look at this one, $280,000 first lien home equity line of credit. But what I did is I paid off my mortgage first, and then I got the first lien home equity line of credit. Whereas while I was paying off my mortgage and all of my other debts, I used a second lien HELOC. Okay. So, and as you can see here, this is just me flexing a little bit. But I did pay off my mortgage under 3 years. So if you want to pause that and see if I'm, telling the truth or not, pause the video and then just look at it and you'll see that I paid off my mortgage in 2 years and 9 months. Okay. Now, here's the thing. There's a guy in Australia who came up with the HELOC pay off your mortgage concept. Okay. And I've taken an excerpt out of his book, right? And he basically writes in his book, his name is Harsh Gill. Harsh Gill. I forgot what the actual name of the book was. I can't think of it, but look up, I think Speed Mortgage Payoff Strategies. I can't even remember, but it's Harsh Gill, okay, from Australia. He wrote in his book that it's a disadvantage to replace your entire loan with the line of credit. So you see the red right here disadvantage. You are exposing your entire loan to the line of credit. And he wrote this in 2003, folks. So we're kind of going backwards with the velocity banking teachings if we're telling people, hey, replace your entire mortgage with the line of credit. And then he says right here, option two, take out a smaller HELOC as a second mortgage recommended. Right. So if you want to pause that, you can read it. But I'm just telling you, even back in the day when people talked about the strategy, no one was telling people, hey, replace your 2.5% mortgage with the home equity line of credit. Okay. But we're going to do the math. Okay. And so with velocity banking, okay, we assume we have the same income, same expenses. Um, and let me just copy the expenses here. And we're going to have zero savings, but we're going to calculate our cash flow, which is like savings. Now, here's the thing. Well, usually with the first lien home equity line of credit, we use it, it's promoted to use it to replace all of our debt, right? So I did the tally here. This is $167,000 of credit card debt and 917,000 in debt in total. Okay, so I did the math for you. But let's go ahead and assume that we moved all of our debt into the line of credit. Okay, so this I'm just going to go this, and now all the payments here are zero. Okay, and so now we have $13,000 of cash flow, but remember there's an interest cost to the line of credit. Okay, so let's go ahead and calculate that. I2 plus 1, so G2 plus H2 minus our cash flow, which is 13,000. So again, the final step of the strategy is dumping all of your 16 grand into the line of credit and then taking 3,000 out. And then after every single month, the 13,000 will be used to bring down the balance of the debt. But oh, wait, there's more. Remember that from Scary Movie? All right. So 13,000 is the amount that the balance of the line of credit should go down, but there's the interest cost of the line of credit, which we have to calculate. Okay, so it's average based on the average daily balance multiplied by the interest rate, and then we divide by 12, right? Interest rates are always quoted annually, but they're calculated monthly, which is why we divide by 12. And look at this, the interest for um month one is about 6 grand. So our cash flow technically isn't 13 grand, it's about seven. Okay, which is not bad, but it's like, who wants to pay more interest than they have to? Okay. So as you can see here, all I got to do is copy and paste, and then we're going to figure out when all of this debt gets paid off, right? So copy and paste these formula. Did I already do? Okay. And then scroll down. Okay. So now 96 months, that's how long it takes to pay off the first lien HELOC. Okay. So 96 months. Yep. I already did that right here. Okay. So I think this is my work from previously, but well, it's okay. It's okay. You see, I like to rehearse a little bit. All right. So now let's go ahead and sum this up, right? So let's sum it up. And if we sum up the interest, because this is what this column is, right? This is the interest column, how much we pay to use the line of credit. It's going to be about 318K. 318K. Okay. So let me, I kind of already did this here. Oh, 316? My bad. Must have calculated it wrong. All right. Well, I'll put 318. Okay. So 318 to do a first lien HELOC. And so what do we pay? Interest in time, 96 months and 318 in months in time, and then $318,000 of interest. Okay. Oh, ooh, excuse me. I'm burping. My bad. All right. So that's how long it'll take for you to pay off your first lien HELOC. If you literally replace your 2.5% mortgage with the 8% HELOC, right? And so what we're going to do is we're gonna do it in small chunks. Okay, so instead of a $920,000 home equity line of credit, which is insane, we're gonna just use a $200,000. And you might be, that's insane too, right? But I do, like I said, I have a $280,000 home equity line of credit right here. But let's just assume that instead of getting a $920,000 first lien HELOC, we get a $200,000 home equity line of credit. Okay, so now let's do the second lien HELOC. So wait a minute. Did I get confused? I think I might have confused myself. All right. So let's go back here and then do the second lien HELOC. And so when we do the second lien HELOC, debt payoff order is incredibly important, right? So I don't know if you ever heard of this thing called the cash flow index, but it's an easy way to prioritize how you pay off your debt, right? So we're just going to do a quick Google search on cash flow index. And I didn't start using this until people started randomly sending me their spreadsheets with like literally more than 20 debts. And I was like, I'm so confused of which debts to pay off. And I realized this is probably the easiest way to figure out what debts to pay off. And basically, the higher the number, that's what they call efficient debt, meaning it doesn't take up that much of your cash flow compared to the amount of debt that you have. Okay. So we're going to go ahead and do this and with a calculate the cash flow index. So we're going to do this 5,000 divided by 175. So the formula is the statement balance divided by the monthly payment. Okay. And then just do it for all of them. So 8,000 divided by 260 equals 15,000 divided by 487.5. And then this one is 27,000 divided by 855. This one is 30,000 divided by 1050. This one is 7,000 divided by 227.5. This one is 10,000 divided by 258.33. Okay, this one is 35,000 divided by 1137.5. All right, divide here, and then 12,000 divided by 310. This one is 18,000 divided by 585. Okay, well, I screwed up here. Not 180,000. And then this one, I actually have this calculated somewhere else. So let me copy and paste this because I'm a little bit lazy. Okay. All right, so let's go ahead and do this here. And I'm gonna copy and paste. Oh no. Uh-oh. Wait a minute. Oh, okay, good. Oh, all right, so this is going to be values only. Okay, so as you can see here, this is like a ranking system, or you could think of it as a ranking system to pay off your debt. Okay, so here you see this mortgage is 253. It's a very high number. It means that you don't get enough bang for your buck for paying this off. See how that works? That's why we don't replace our mortgage with the line of credit because you don't get enough cash flow. Okay. And the whole name of the game is maximize the cash flow, regardless of the interest rate. Now, even though the interest rate does affect the cash flow. Okay. So let's go ahead and do this and just pay it off in little chunks and pieces, right? We start off with the low numbers, the ones below 50, right? So if you take a look here, it says, let me see, 50. A high number over 100 means a loan is efficient. A low number under 50 means it is inefficient. So let's go ahead and pay off our quote inefficient debts, okay? Inefficient debts. And so what we're going to do is move all these credit cards, and we have how much in the credit card debt? $167,000, 167,000. All right. And then now we just put the credit cards to zero and leave the rest. So that's 10 credit cards to zero, and now this is $7,000 of cash flow. So instead of 13,000, we just do 7,7050.71, and then we just copy and paste and see when it becomes red, right? And then we see here that in month, we'll see 26, we paid off all the credit cards, okay? And let's just do this, just kind of keep a tally of this. So credit card, we paid off in 26 months. And how much interest did we have to pay? So let me go ahead and calculate this, sum it all up. No, I don't want to sum this up. I want to sum up. Am I doing this right? Why does it sum horizontally? Let me delete this. Okay, does it sum vertically now? Yes, it does. Okay, 14.6 grand of interest to pay off all the credit card debt. Not bad, 14.6K. Now, we have a loan calculator, okay? And again, looking at these cash flow indexes, then we go with the next order and 90, and then this is 253. Now, with amortized loans, the cash flow index does change because even though the monthly payment stays the same, the balance does die over time. And so what we do is we put the number 26 months into our loan calculator, right? So if we have these factors, and I'm not going to go over this, you just type in 26, you could see the current cash flow index number, right? And so what we do, again, these are below 50. Let's pay these off first and move them into the line of credit. And so if it's G2 plus G3, right, that's 36.5 grand. 36.5 grand. We're going to move into the line of credit. And let's go ahead and do that. So we're just going to do this right here. Let me go ahead and copy and paste, and then copy and paste. All right, so now this is plus 36544.59. We'll round up. Okay, now because we moved those two auto loans, our cash flow is going to increase because those auto loan payments are now gone. So this is 0, 0. And then this is 8.2 grand in our cash flow. And I know I'm going fast, but just pause it if this is going too fast for you. I'm a real ninja with this stuff because I've been doing this. I want to say 10,000 times, but not really. Okay, so 8238.78 is our new cash flow. And let's go ahead and copy and where did this come from? Oh, you know what? I screwed up. Okay, so now let's go ahead and copy and paste this. And we see that in 31 months, those two auto loans were paid off, right? 31 months. So auto, 31 months. And now we got to calculate the interest. So the interest is going to be from here to here, right? So let's go ahead and calculate that sum. And I'm going to do that right here, right? Oh, no. Okay, so let's just do this right here. So that's about $500, okay? So it's not, yes, it costs us $500 to use the line of credit, but we also have to take into account the interest that we pay during the regular payments of the loan. So what we do is, let me just take, where's the loan, auto loan right here. So this is now 0, this is now 0, and then what we do is we just calculate this, right? Take the sum of these two. I know this is kind of small. Let me make it a little bit bigger. Hold on. Let me see if I can make it bigger. Okay, so let's just do this right here. Paste the values, and then what we do is we take the sum. Why is this going so crazy on me? All right, let's take the sum. Equals K2 plus K3. And that's about 7.4 grand plus the $500 of the line of credit. So we'll just do some cowboy math and say 8 grand, okay? So 31 months, and then we'll do 8K into the line of credit. So that's how much the auto loans have cost us, about 8K. All right, so now, okay, let's go ahead and do this. And I know I'm going a little bit crazy with all of this right here. Now, when it comes to dealing with loans, so 31, 31, 31, where the cash flow index is above 50, just as a general rule, if you have an interest rate that's lower than the line of credit, the most safest way of paying it off is what we use called the chunking method, meaning we just pay it off in little pieces, right? The size of the piece is kind of irrelevant just as long as it's a small piece. So we'll just say like our income, okay? Same as our income. So let me go ahead, and now what we got to do is put this all good stuff into the line of credit, or I'm sorry, not the line of credit, into the velocity banking calculator. And all we got to do is plug and play the numbers. So we have this velocity banking calculator right here where we literally just plug in the numbers. That's it. We just plug in the numbers and it's simple. Okay. So what's the original balance of the line of credit? I'm sorry, the loan. It's $160,000, 160,000. What's the current balance at? Are we at month 31? Let me just quickly check. Yeah, we're at month 31. Month 31, and the balance is 127,350.21. So I'm going to copy that down. 127,350.21. What's the interest rate? It is 6% for 10 years. And what's the balance of the line of credit? Or not the line of credit. Wait, did I do that right? No, it's the payment amount. I'm sorry. I'm going crazy. I'm trying to do the much too fast. 1776.33. Ooh, lucky number. 1776.33. All right, so now our monthly expenses. What's our monthly expenses? Well, it's everything except for the loan we're trying to pay off, right? So, whoopsie. It's basically these three. So let me go ahead and sum this up. 5984.89. So that's our expenses. 5984.89. Whoopsie. 5984.89. Okay. Ooh, take a look at that. So 1.1 years is the payoff time, and the interest is 4.6 grand. Now, let's say we had replaced the entire thing with the line of credit, and we'll see what the difference is. You pay 1 grand more. So it's not a big deal. Okay, it's not a big deal. But let's go ahead and just record this. So 1.1 years. 1.1 years right here. So law 1, that would be 31 plus 1.1 times 12. So that's going to be 40, we'll say 45 months. Law school 1, loan 1. 45 months. And then, okay, 45 months. And then now we got to calculate the interest. So the interest is going to be 4.6 grand, 4.6 plus, let's see, plus this. So 4,600 plus this. And so now let's go ahead and sum that up. Well, we don't want to sum up the whole thing. So this is, I'll just be lazy. It's 27K. 27K is the interest, okay? 22 plus 4,600, so about 27K. All right, so 4.5 months plus 27K, that's how much the first law school loan costs, because we're assuming this is a dual income household. And then we're going to attack the second law school loan. So at 45 months, right, what's the balance of this one? And so now, okay, so 45 months. Now we just got to fill in these numbers, right? So we just do 130,000, 5.4. What's the payment amount? And then what's this? So I know I'm going a little bit fast, but I don't want to be here for all the time. So what's the current balance? It is 89,229.14. 89,229.14. And then what's the payment amount? It's 1,404.41. All right, so now the living expenses, what's the living expense? Well, we go back here. It's everything except for the loan we're trying to pay off. So now it's 4580.48. So 4580.48. And now we see that the interest is 2 grand. Okay, so let's go ahead and calculate this right here. And again, I know that it's a lot. So this will be about 26 grand. 26, yeah, we'll just say 20. Just do 20. See, they're both 27K. We'll just use a simple figure for both. It's about 26, but it's all right. We don't have to be that accurate. Let's overestimate a little bit. So now Law 2 is still going to be about 27K. And then we take a look here. It's about 0.7. So 0.7, so 45 plus 0.7 times 12, not 25. That's about 54 months, okay? So 54 months for law school loan 2. And then now we tack the mortgage. So at 54 months, what's the balance of the mortgage? It's 357, and we just do the same thing, right? So now this is going to be about $3,000 a month. And then we just kind of do reset these. So this is going to be 30 years. Original balance, what's the original balance? I think it was 300,000. And what's the current balance? It's 400,000 at 2.5%. So 400,000 at 2.5%, and then the current balance is 357,343.83, right? Yeah. 357,343.83. So 357,343.83. And then the payment amount is 1580.48. 1580.48. Okay, so how long does it take to pay it off? 2.4 years. Now, this is extremely quick, right? But let's say even at this point, we decided we're going to replace our mortgage with the line of credit. So all I got to do is just replace this number, and you see it's 38 grand, 2.6 years and 38 grand of interest. Now, which would you rather pay? 12 grand or 38 grand? I'll pay the 12. All right, I'll pay the 12. And so now what we got to do is just to calculate the amount of interest paid, it's literally just approximately, okay, I'm not saying this is like super, well, I guess it's kind of as much as accurate as possible. So 42 grand plus 12.6 grand, so 12,600. Let's see, 12,600. We'll do that estimate. And then now we're just going to do K6, no, I'm sorry, J6 plus K6. So about 55 grand in total for the mortgage, right? So we'll just say 56 grand. So mortgage took us 56K of interest, right? And how much time? So that's 2.4 years. So 54 divided by 12 plus 2.4, 6.9 years in total for all of our debts, right? I hope I'm doing this right. All right. So to pay off all of our debts, including our mortgage, it takes us 6.9 years. Now, let's add up the interest, right? So if we do math here, 96 divided by 12 is 8 years. So that's why we have the 8 years here. Now, so this for their second lien HELOC is 6.9 years, okay? Now, let's go ahead and add up the interest and compare it to here because we're paying about 318K of interest. So let's go ahead and add them up. So 14.6, actually it might be easier if I do it this way. 14.6, 8, 27, 27, 56, okay? Let's go ahead and add it up. Ooh, 132, we'll say 133K of interest. So what's 318 minus 133? 185K difference, 185K difference of interest. So here's the thing, okay? I don't know about you, but I don't want to have to pay $185,000 more than I have to, okay? I might, that's like how many Teslas? At least a couple, which is a number that's not even a real number. But I've been thinking, right? Instead of giving the $185,000 to the bank when you don't have to, just purchase a Renatus education so you wouldn't have to, you would have increased the probability of not having to had to go through this. Okay, that's just my real pitch right here. Again, I'm like the Costco demo guy. I don't tell you whatever I do is good or not. I don't give financial advice. I just do demonstrations, and then you decide if whether you want the product or not. See how that works? But you can see here that when we do the second lien HELOC, we waste time and we waste interest, right? So that's why I wrote as the thumbnail, the first lien HELOC is a waste of time and money, time and money, $185,000 difference. And also let's just calculate the time. So 8 minus 6.9, that's 1.1 year difference. So the time differential isn't that bad, but the interest differential, ooh, that there's two different types of oohs. There's like the good ooh, like ooh, that's really good. That's a fine piece of chocolate that's presented in front of me versus ooh, that's a rotten meatloaf sandwich, right? So you decide. But again, I'm not here to give you advice, but you can see why I make these videos because of the things that I just see on the internet that make no sense to me. Okay. All right. Well, that's it for today. It's Korean Atlanta Mentorship. Have a great day, and we'll speak next time.